Many aspiring traders suffer heavy losses from emotional impulses and lack of discipline, causing financial pain and frustration. They seek proven strategies to build consistent success. Trading Habits delivers 39 powerful rules from 20-plus years of expertise, transforming rules into habits for low-risk profitability, master foundations, emotional control, and keys to gains like top traders. Let's find out more.
It's great to be here. We look at a lot of books in this space, and so many of them are they're so academic, full of these complex models that, frankly, fall apart the second you face a real, live market.
Right, the moment you actually have money on the line.
Exactly. This one, though, feels different. It reads less like a textbook and more like a field manual for survival.
A survival manual, that's the perfect way to put it. Today, we're doing a deep dive into Trading Habits, 39 of the world's most powerful stock market rules by Steve Burns and Holly Burns. And to your point, this isn't some professor in an ivory tower. Steve Burns has been in the trenches for, over 20 years now?
Which is so important. I mean, if you haven't felt that pit in your stomach when a trade goes against you, it's really hard to teach someone else how to avoid it. And his backstory really sets the stage for the whole book.
Yeah, let's start there. When did Steve Burns start trading? Because it really grounds all the advice that follows. He talks about getting interested as a teenager.
As a teenager, yeah. But not in the way you'd think. He wasn't, watching Wall Street and dreaming of a Lamborghini.
No, not at all. He mentions being fascinated by compound return tables.
Which, let's be honest, that's a very specific kind of kid.
A special kind of nerdiness, for sure. But it shows you where his head was at from the very beginning. He wasn't looking for a lottery ticket. He was looking at the math.
The inevitability of the math, that exponential curve. He saw the magic in it, the idea that if you can just consistently grow your capital, the numbers eventually do all the work for you. But you have to remember the context of when he started.
Oh, this is a huge point. The pre-internet era.
The pre-internet era. We take it for granted now that we have a live, quote, machine in our pockets, right?
The supercomputer, yeah. If I want to know where Apple is trading, I just look. He was literally looking at stock quotes in a physical newspaper.
Can you just imagine that for a second? The feedback loop? You make a decision, maybe you call your broker on a landline.
And then nothing. You just wait.
You wait for the paper boy the next morning to find out if you made money or lost money. It's agonizing to think about.
It sounds agonizing, but there's a part of me that wonders if it was a little healthier. You couldn't obsess over every little tick up and down.
It forced a certain kind of patience, that's for sure. The friction was so high you couldn't just trade out of boredom. But even with that, he's very open about the fact that the learning curve was brutal. He read hundreds of books, but he still made all the classic mistakes.
Which is really the whole motivation for writing Trading Habits, right?
Yeah.
He basically wanted to build a time machine.
A time machine, a shortcut. He wanted to send a message back to his younger self saying, look, here's how you avoid all the pain I went through. Here are the things that actually matter.
And that word shortcut usually sets off my alarm bells. In finance, shortcut almost always means get-rich-quick scheme.
Right.
But that's not what he means at all. The shortcut here is about avoiding the dumb mistakes.
Exactly. The shortcut isn't to making more money faster. It's to not losing all your money while you're still learning. And the core idea, the whole mechanism for doing that is right there in the title. It's about habits.
Not just rules.
Not just rules, habits. That's the power of habits.
Okay, so let's dig into that. Transforming rules into reflexes. Why is that distinction so important? Why can't I just write, don't lose a lot of money on a sticky note and put it on my monitor?
Because in the heat of the moment, when your emotions are firing, you won't read the sticky note. He pulls from Brett Steenbarger, who's a legend in trading psychology, and makes this comparison to performance disciplines, like sports. Think of a professional golfer standing over a critical putt.
Right. The Masters is on the line.
Exactly. Does that golfer stop and think, okay, now my grip pressure needs to be a 4 out of 10, my shoulders need to be aligned, I need to keep my head down?
No way. If they're thinking, they're lost. It's all muscle memory at that point. They just react.
They flow. But, and this is the key, when they were 10 years old, a coach was drilling those things into them. It started as a set of mechanical rules. Keep your elbow in, follow through. It was awkward and clunky. Burns is saying that trading is the exact same journey.
So you start with what he calls conscious competence.
Right, where you're following a checklist. It's very robotic. If A happens, then I do B. But the goal is to get to subconscious competence.
Where you don't even have to debate with yourself. You see the setup, you take the trade, you see your stop get hit, you're out. No hesitation.
You want to get to the point where breaking one of your own rules feels, well, it feels physically wrong, like touching a hot stove. If your rule is, I don't hold a stock through a bad earnings report, and you find yourself tempted, your stomach should clench. You should feel this visceral reaction that stops you before your brain even has a chance to rationalize a bad decision.
That's a high bar. That sounds like true mastery.
That's what he calls trading maturity. And he gives us this beautiful summary of the transformation. He says, you must replace opinions with signals.
Okay.
You must replace ego with position sizing.
Oof, that's a big one.
And you must replace emotions with a trading plan.
Opinions to signals, ego to position sizing, emotions to plans. I love that. That's a perfect framework. Let's use that as our map for this deep dive. The book has 39 rules, which is a lot to get through, so we've grouped them. We're going to start with the bedrock, rules 1 through 15, the foundation.
This is all about the math and the basic mechanics of the market. And it's so fitting that rule 1 is the math of winning.
And this, right here, is where I think almost every new trader gets it completely wrong. We're all conditioned by school, right? 90% is an A, 70% is a C, 50% is a failing grade.
That academic mindset is a portfolio killer. It just is. Burns spends a lot of time hammering this point, debunking what he calls the high win rate myth. He says there are basically 2 paths to profitability. Path A is high accuracy.
You're right most of the time.
You win on, say, 8 or 9 out of 10 trades. Path B is high reward. You might lose a lot, but your wins are huge compared to your losses.
But he gives this critical warning that path A, the high win rate path, is actually incredibly dangerous. Why is winning a lot a bad thing? It sounds like what everyone wants.
It's how you have to behave to achieve it. To get that 90% win rate, you typically have to take profits the second a trade goes green, just tiny little wins. But the other side of that coin is the fatal flaw.
You hold your losers.
You hold your losers forever, praying they come back to break even, because you cannot stand the idea of taking a loss and messing up your perfect report card.
I see it now. So you're out there picking up pennies, feeling really smart, and then a steamroller comes along and flattens you because you refuse to accept a small loss.
Precisely. One catastrophic loss wipes out dozens and dozens of those tiny wins. So Burns says, forget path A. Path B is where professionals live. The holy grail isn't being right all the time. It's your risk-to-reward ratio.
I was looking at the math he lays out in the book, and it's so counterintuitive, but so powerful. Can we just walk through the numbers? Because I think this is a genuine paradigm shift for a lot of people listening.
Absolutely. It all comes down to the relationship between what you stand to lose and what you stand to gain. Let's start with a simple one, a 1-to-3 risk-reward ratio.
So for every $1 I'm willing to lose on this trade, my target is to make $3.
Exactly. So with that ratio, what percentage of the time do you think you need to be correct just to break even?
My gut would say, I don't know, maybe 40 or 50%.
You only need to be right 25% of the time.
Wait, say that again?
25%. If you lose 3 trades, you lose $3. If you win 1 trade, you make $3. You're back to 0. So if you can be right just 30% of the time, you're making money.
I need a second to let that sink in. I can be wrong 70% of the time.
Yeah.
I can fail far more than I succeed and still be a profitable trader.
Yes. And it gets even crazier. If you can find trades with a 1-to-5 ratio risking $1 to make 5, you only need a win rate of about 17% to be profitable. You can be wrong more than 8 times out of 10.
That just takes so much pressure off, the pressure to be a perfect fortune teller.
It removes the crystal ball from the equation entirely. You don't have to predict the future, you just have to manage the math. Cut your losses small, let your winners get big. You can be a terrible forecaster and an incredible trader.
And that flows perfectly into Rule 2 and Rule 22, which is this whole idea of facts versus opinions. This seems to be one of Burns' biggest pet peeves.
Oh, it is. And he draws a very, very hard line. An opinion is something like, I think the stock has gone down too much, or I feel like the economy is improving, so the market should go up.
This is a great company. It has to bounce back eventually.
Exactly. All opinions. And the market could not care less about your well-reasoned opinion. It doesn't care about your story. It doesn't care about your feelings. Burns says you must trade verifiable signals.
Okay, so give me a concrete example. What's the difference between an opinion and a signal in practice?
An opinion is, I'm going to buy the dip in this stock. That's totally vague. What's a dip? Down 5%, down 20%.
Right, subjective.
A signal is, I'm going to buy if the stock pulls back and successfully tests the 50-day moving average as support.
Because that line on the chart is a quantifiable fact.
Yeah.
The price either touched it and bounced, or it didn't. There's no room for debate.
It's binary. It removes the ambiguity. It's the difference between being predictive, trying to guess what's going to happen, and being reactive. You're just waiting for the market to show its hand, and then you act.
Speaking of the market showing its hand, let's get into trend identification. This is covered in Rules 4, 5, and 7. There was a quote in here that it clicked for me. The answer to the question, what is the trend, is the question, what is your time frame?
It's brilliant because it's so true. It highlights the fractal nature of the market. You can be looking at a 5-minute chart and see what looks like the crash of 1929.
But if you zoom out to the weekly chart, it's just a tiny blip in a massive multi-year uptrend.
And both are technically true. So whose truth do you trade?
So how does Burns suggest we navigate that, this sort of schizophrenia of different time frames?
He's a big believer in a top-down approach. You have to start with the big picture. He says, look at the weekly chart first. That's the tide. Is the tide coming in or going out?
I like that analogy.
Then you zoom into the daily chart. Those are the waves on top of the tide. And only then, if you're a really short-term trader, do you look at the hourly chart, which is like the ripples on the waves.
And to simplify this, he points to moving averages as the ultimate cheat code.
Right. The ultimate cheat code. It's the quickest way to just strip out all the noise and emotion. Is the price above this key average? It's in an uptrend. Don't overthink it. Is it below? It's in a downtrend.
I want to spend a minute on Rule 5, which is this concept of accumulation versus distribution. It made me think of like whale watching in the stock market.
That's a perfect metaphor. The whales are the giant institutions, the pension funds, the mutual funds, the players with billions of dollars. When they decide they want to buy a stock, they can't just put in one giant order for 10 million shares.
Right, because the price would just explode upward. They'd create their own bad entry price.
They'd spike the market against themselves. So they have to be subtle. They have to accumulate. They buy a little bit today, a little more tomorrow. They buy on down days. And this quiet, steady buying pressure creates a very specific pattern on the chart.
Higher lows.
Higher lows. Every time the stock dips a little, they step in and support it. They put a floor under the price.
And distribution is just the opposite. It's them trying to get out without crashing the stock.
Exactly. They can't just dump all their shares at once, so they sell into strength. Every time the retail crowd gets excited and chases the stock higher, the whales are quietly selling into that excitement. And that creates a pattern of lower highs.
So Burns' advice is simple. You're not the whale. You're the little remora fish.
Find the whale and hang on for the ride. If they're accumulating, you should be buying. If they're distributing, you should be selling or staying away. Trade with the flow of big capital, not against it.
One of the most fascinating psychological ideas in this whole first section was Rule 6, support and resistance memory. I had never really thought about a chart having a memory before.
It's so cool because it's not the chart that has the memory, right? It's the people. The humans who own the stock. This is pure, unadulterated market psychology. Let's walk through resistance. Imagine you bought a stock at its absolute peak, say $100 a share.
Okay, I'm in at $100. Classic move for me.
And naturally, the moment you buy, it tanks. It drops to $80. How are you feeling in that moment?
Oh, I feel sick. I feel stupid. I'm filled with regret. And I'm just praying.
What are you praying for?
Please, please, just get me back to $100. Let me get out of break even. I swear I will never make this mistake again.
That is the universal prayer of the trapped buyer. Now, imagine there are thousands, maybe hundreds of thousands of people who all bought around $100 and are all saying that same prayer. There is a giant wall of supply of people desperate to sell, waiting at that $100 level.
So when the price finally claws its way back up to $100,
they all hit the sell button at once. That sudden flood of selling pressure stops the rally in its tracks. That is why resistance forms. It's a monument built to past regret.
that is such a vivid way to think about a simple line on a screen. And support is just the opposite. It's built on a different emotion.
It's built on FOMO, fear of missing out. These are the people who watched the stock go from $100 to $150 and were kicking themselves the whole way up for not buying it. They all tell themselves, man, if that stock ever pulls back to $100 again, I am jumping on it this time.
So when it does drop back to $100, all those I wish I had buy orders come flooding in.
And it creates a floor. So when you draw these lines, you're not just doing technical analysis. You're mapping the emotional landscape of the market. You're mapping the pain and the greed.
We can't talk about important lines on a chart without talking about the big one. Rule 11, the 200-day moving average. Burns calls this the line in the sand. Why that number? Why 200 days?
It's not magic, but it's important. 200 trading days is roughly 1 calendar year. So it represents the long-term consensus of value for a stock or an index. And because the big institutions all watch it and the algorithms are all programmed to react to it, it becomes a massive self-fulfilling prophecy.
And the rule for using it is about as simple as it gets, isn't it?
It's incredibly binary. If the price is above the 200-day line, you're in a bull market environment. You should be looking for opportunities to buy. If the price is below the 200-day line, you're in a bear market environment.
And he has a very specific quote here. Bad things happen below the 200-day moving average.
Very bad things. Crashes, bankruptcies, systemic collapses. Go back and look at the chart of the S&P 500 in 2008, or the NASDAQ in 2000, or even the brief COVID crash in 2020. In every single case, the market broke below its 200-day before the real terrifying part of the sell-off began.
So it's a filter. It's a safety mechanism. If you just had one rule that said, I will not own any stock that is trading below this line, you'd miss some of the recovery, but you'd also miss the utter devastation.
You'll never buy the exact bottom, and you'll never sell the exact top. But you'll participate in the big, safe middle part of the trend, and crucially, you'll avoid the disasters. It's a survival tool.
Before we move on from the mechanics, let's just quickly touch on timing. Rules 9 and 10. He talks about gaps, but also the time of day. What is amateur hour?
Amateur hour is the first hour of trading, from 9:30 a.m. to 10:30 a.m. Eastern.
And why is it for amateurs?
Because it's pure, unadulterated emotion. It's all the pent-up fear and greed from the night before being unleashed on the market at once. People read some headline overnight, they panic, and they put in a market order to sell at the open. It's chaotic, it's volatile, and the price just whipsaws all over the place.
It's mostly noise then.
It's mostly noise. It's full of false signals.
So if that's when the amateurs play, when do the professionals, the smart money, make their moves?
In the last hour of the day, from 3:40 p.m. to 4:00 p.m., this is the lie detector hour. This is when the big funds and institutions look at everything that happened during the day and decide, okay, is this move for real? Are we willing to hold this position overnight?
So the closing price is the most important price of the day.
By far. If a stock is showing real strength at 3:05 p.m., that strength is legitimate. If it was strong at 9:35 a.m., that could have been anything. It's such a simple, actionable piece of advice. Stop getting chopped up in the morning chaos. Wait and see what the market is telling you at the end of the day.
All right, that's a perfect transition. We've covered the mechanics, the charts, the math, but that's only half the game, maybe even less. Now we have to talk about the software running inside our own heads. Segment 3, rules 16 through 27, mind over emotion.
And this is the hard part. I mean, you can teach a reasonably smart person to read a chart in a weekend, but teaching a person to control their own fear and greed, that's the work of a lifetime.
Rule 16 just comes out swinging. The dangers of hope. Now, in everyday life, hope is a virtue. It's a wonderful thing. Why is it such a dangerous four-letter word in trading?
Because in the context of trading, hope is almost always a euphemism for denial. Think about it. When do you find yourself hoping in a trade? You're never hoping when you're winning.
No, when you're winning, you feel like a genius.
You feel smart. You only start hoping when you're losing money. I hope this turns around. I hope the Fed says something to save me. I hope earnings are good.
It's a passive state. It's a prayer.
It's a prayer, and it creates an action. It paralyzes you. Instead of looking at the fact on the screen, the price is breaking my support level, I need to exit, you cling to the hope that it might come back. Burns' mantra is simple. Trade hope for facts. The moment you catch yourself hoping, you need to realize you are no longer trading your plan. You're gambling.
Which leads us into this idea of contrarian thinking. Rules 17 and 26. Crisis equals opportunity. We've all heard the phrase, buy when there's blood in the streets. But it's not as simple as just buying anything that's going down, is it?
No, he's very careful to add nuance. He's not saying you should try to catch a falling knife. What he's saying is that mathematically, the greatest opportunities, the trades with those 1-to-5 or 1-to-10 risk-reward ratios, only appear during periods of maximum fear.
Okay, so how do you know when it's maximum fear and not just the beginning of a slide to zero?
Well, he offers a few indicators, but my favorite is a social one. He calls it the everyone hates your trade indicator.
I love the name. How does it work?
It's exactly what it sounds like. If you're at a party or talking to friends and you mention a stock you're thinking of buying and everyone just groans, if they tell you you're insane, that the company is doomed, that it's the stupidest idea they've ever heard,
That's actually a good sign.
that's an incredibly bullish sign, because what does it mean if literally everyone hates it? It means that everyone who was ever going to sell has already sold, the selling pressure is exhausted, there's nobody left to push the price down.
And on the flip side, if you mention a stock and everyone says, oh yeah, I own that too. My cousin's a genius. He told me it's going to the moon.
Run for the hills! Because if everyone has already bought, who is left to push the price higher?
That is brilliant. Rule 21 is one that I struggle with personally a lot. The art of doing nothing.
If there's nothing to do, do nothing. It sounds so simple, so zen. But for most of us, especially people who are, high achievers, it is excruciating.
It feels like being lazy. We're conditioned our whole lives that effort equals results. Work equals money. If I just sit on my hands all week and don't place a single trade, I feel like I'm not doing my job.
But in the business of trading, working often means forcing a suboptimal trade just for the sake of being busy. And that's how you lose money. Burns makes the point that cash is a position. Sitting in cash, patiently protecting your capital while you wait for a perfect high probability setup to come to you, that is an active decision. It's called playing defense.
It's the difference between a sniper and a machine gunner.
That is the perfect analogy. The sniper might lie and wait for 3 days, do nothing, take one perfect shot, and achieve the objective. The machine gunner sprays bullets everywhere and runs out of ammo in 10 minutes. The ammo is your trading capital.
Let's talk about news. Rule 27. This was a huge aha moment for me when I was reading the source material. He says you shouldn't trade the news itself. You should trade the market's reaction to the news.
This is such a pro-level concept. It's all about what the market has already priced in. Let's play this out. A company reports terrible earnings, profits missed expectations, guidance is weak. What should the stock price do?
It should go down, obviously.
Okay. But what if, on that terrible news, the stock price goes UP?
Then something's broken. I'm confused.
You shouldn't be confused. You should be paying very close attention. Because if a stock can rally on objectively bad news, what does that tell you? It tells you that the market was expecting news that was even worse. It tells you the selling is exhausted and the underlying demand is so strong that buyers are absorbing the bad news and still pushing the price higher.
A massive sign of strength.
An enormous sign of strength. And the opposite is even more telling. If a company reports record-breaking earnings, fantastic news, and the stock sells off.
That's incredibly bearish.
Incredibly bearish. It means all the good news was already baked in, and now the big players are using that news as an opportunity to sell to the unsuspecting public. So the rule is, ignore the headline, watch the price action. The price tells you the truth.
To wrap up the psychology section, let's touch on rules 19 and 23, which are all about managing the self. He talks about using your own body as a risk meter, the sweaty palms test.
It's so primal, but it's so effective. Burns says if you enter a trade and within minutes your heart starts to race, or you feel that clammy feeling in your palms, or you find yourself compulsively checking your phone every 30 seconds.
Your position is too big.
Your position is too big, period. End of story. Your body's ancient fight-or-flight system is telling you that you have taken on too much risk.
Your amygdala knows you're over-leveraged before your conscious brain is willing to admit it.
Exactly. And when that fear center of the brain is firing, it literally shuts down the logical, rational part, the prefrontal cortex. You become objectively dumber when you are scared or greedy. So the only solution is to trade at a size that is so small, you're almost bored by it.
Boredom is profitable. Excitement is expensive.
That should be printed on the wall of every trading desk.
All right, let's move into our next segment. This is the part that isn't glamorous, but it's what separates the pros from the amateurs who blow up their accounts. Rules 28 through 39. The keys to profitability, which is really all about risk management.
This is it. This is the whole game. New traders obsess over entries. They spend all their time asking, what's the perfect signal to buy? Professionals obsess over risk. They ask, how and when will I get out if I'm wrong?
Rule 28 gives us a simple but powerful framework for this. The 4 outcomes.
Burns says there are only 4 acceptable outcomes for any trade you take. Number 1, a small win.
Okay.
Number 2, a big win. Number 3, a small loss. And number 4, breaking even.
And what's so powerful is thinking about what is not on that list.
The big loss.
The big loss. The account killer. The trade that emotionally scars you for months.
He argues that if you can just design a system that makes the big loss a mathematical impossibility, your returns will improve dramatically, even if you don't find any more big winners. It's addition by subtraction.
So how do you do that? How do you make the big loss impossible? This brings us to probably the single most important rule in the entire book.
Okay.
Rule 32, the 1% rule. I want to go slow here because this is so often misunderstood.
Yes, let's be extremely clear. The rule is you should never risk more than 1% of your total trading capital on any single trade idea.
Okay, let's use an example. I'm a trader and I have a $100,000 account.
Okay, so what is your maximum allowable dollar risk on your next trade?
1% of $100,000, which is $1,000. I cannot lose more than $1,000.
Perfect. Now here's the question that trips everyone up. Does that mean you can only buy $1,000 worth of stock?
And the answer is no. This is the common mistake.
Yep. No, absolutely not. It has nothing to do with how much stock you buy. It has everything to do with where you place your stop loss order to get out.
Okay, walk me through the calculation. I want to buy stock XYZ, and it's trading at $50 per share.
The first step is not to decide how many shares you want. The first step is to look at the chart and decide where your exit point is. Where is the price that proves your trade idea was wrong?
Okay, I look at the chart and I see a key support level at $49. So I'll decide my stop loss goes just below that, say at $48.50.
Great. So what is your risk per share?
I'm buying at $50, getting out at $48.50. My risk is $1.50 per share.
Exactly. Now you know your total allowed risk is $1,000. And you know your risk per share is $1.50, so you just do the division.
$1,000 divided by $1.50 is $666.66. So I could buy 666 shares.
You can buy 666 shares. And at $50 a share, what's your total position size?
That's over $33,000.
Right. You have a $33,000 position in the market, but you only have $1,000 of actual risk on the table.
That distinction changes everything. It allows you to participate in a meaningful way without betting the farm.
And here's the magic of it. Let's imagine you hit a horrible losing streak. The market is choppy, you're out of sync, nothing is working. You lose 10 trades in a row.
I'm feeling sick to my stomach just thinking about it.
If you're following the 1% rule, after 10 straight losses, how much is your account down?
About 10%. I started with $100,000. Now I have $90,000. It sucks, but I'm still in the game.
You are absolutely still in the game. Now, imagine the amateur who is risking 10% per trade trying to get rich quick. After 10 losses,
They're gone, wiped out, game over.
that is the difference between a career and a hobby. The 1% rule is your survival mechanism. It buys you the time you need to learn without going broke.
But this all hinges on Rule 33 and 39. You have to actually use a stop loss, and you have to place it intelligently. He talks about putting it outside the normal noise.
Right. A huge beginner mistake is setting your stop way too tight because you're scared. You buy it $100 and you put your stop at $99.80. The stock wiggles down 10 cents, which is nothing. It stops you out for a small loss. And then it immediately screams up to $120 without you.
That is maybe the single most frustrating feeling in all of trading. Being right on the direction, but getting shaken out by random noise.
It's infuriating. So Burns says, look at the chart. Find the logical place where the story of your trade changes. Maybe it's below a recent swing low. Maybe it's below a key moving average. Give the trade room to breathe. Figure out that stop placement first, and then let that dictate your position size, not the other way around.
Position size is a result of risk management, not a function of ego.
That's the tweet.
Rule 34 adds one more layer of defense, the worst day rule.
Never lose more than 3% of your total capital on your worst day.
So even if a black swan event happens, the market flash crashes and all your positions go against you at once.
The bleeding starts at 3%. It'll ruin your day, but it won't ruin your career. And what this implies is that you can't have, say, 10 open positions that are all correlated, each with 1% risk. Because if the whole sector goes down, you could lose 10% in an afternoon. You have to manage your total portfolio exposure.
Now, I have to play devil's advocate for a second on Rule 36.
Yeah.
Losers, average losers. Because my gut instinct, and I think this is true for a lot of people, is the exact opposite. If I liked a stock enough to buy it at $50, shouldn't I absolutely love it at $40? It's on sale.
It's such a tempting trap. It feels so logical. It's called averaging down, and it's attractive because it lowers your average cost. You bought at $50, you buy more at $40, now your break-even is $45. You only need a small bounce to get out alive.
Right, feels like I'm being smart. I'm fixing my mistake.
But what are you actually doing? You're taking more of your hard-earned capital, and you are allocating it to your single worst-performing idea. You are reinforcing failure. Burns calls it throwing good money after bad.
You're feeding your losers. You're feeding your losers. And you're tying up capital that could have been used on a winning trade, a stock that's actually going up. His rule is simple and brutal. Add to your winners. Never, ever average down on a loser. If a trade is proving you wrong, you amputate it. You don't give it more resources.
Rule 37 is the happier side of that coin, protecting your gains. Never allow a statistically significant unrealized gain to turn into a realized loss. This one hurts in a different way.
Oh, we have all felt this pain. You're up big on a trade. You're up, say, $5,000. You feel like a king. You're already mentally redecorating the kitchen. Then the stock pulls back a bit. Now you're only up $3,000. And you say to yourself, well, I'm not selling now. I'll sell when it gets back to being up $5,000.
The bargaining stage of grief.
Exactly. Then it drops to being up $1,000. Then it's back to break even. Then it's a loss. And eventually you sell out of pure disgust, having turned a huge win into a loss.
Psychological torture. The solution he proposes is a trailing stop. As the stock moves in your favor, you manually or automatically move your stop loss up behind it. You lock in a portion of the gains. If the stock goes from 50 to 60, maybe you move your stop to 55. If it goes to 70, you move your stop to 65. You'll never sell the exact top, but you guarantee you walk away with a profit.
And finally, Rule 35 gives us a plan for when we're just not trading well. He quotes the legendary trader Paul Tudor Jones.
When you are trading poorly, reduce your position size.
Again, this is so deeply counterintuitive. When I'm on a losing streak, my ego is bruised. I want revenge on the market. I want to double down on the next trade to make it all back at once.
That's called revenge trading, and it is the single fastest way to blow up an account. When you're losing, it's a signal. The signal is that you are out of sync with the market's rhythm. Your judgment is cloudy. Why on earth would you make your biggest bets when your judgment is at its worst?
It's like a baseball player in a huge slump trying to hit a grand slam on every pitch.
Yes, you're just going to strike out more. Jones's advice is to do the opposite. Trade smaller, trade tiny, just focus on getting a base hit, rebuild your confidence. Once you're back in the groove and seeing the market clearly again, then you can start to slowly increase your size. You have to earn the right to trade big.
That is just such profound practical wisdom. Okay, we've covered the foundation, the psychology, and the risk management. Let's pull it all together in our final segment, how to be a better trader.
When you zoom all the way out, what's the big message from Burns? It's that trading has to be treated like a business, not a get-rich-quick scheme or a hobby. A hobby is something you pay money to enjoy. A business is something that is designed to pay you.
And to run that business properly, you need that progression we talked about at the start. It has to go from rules to conscious discipline and finally into unconscious habits.
And when you have those habits, that's where real confidence comes from. Rule 25 makes this great point that true confidence in trading doesn't come from arrogance or optimism. It comes from competence. It comes from the quiet knowledge that you've done your homework and you have a plan.
I don't know for sure what the market is going to do next, but I know exactly what I'm going to do in response.
That is the entire game in one sentence.
As we wrap up this deep dive, I want to leave everyone listening with the single most provocative idea that I took from this book. And it's this fundamental tension between comfort and profit.
It's the ultimate paradox of trading, isn't it? Almost everything that feels good and emotionally satisfying in the moment.
Like taking a tiny profit really quickly so you can feel like a winner.
Or holding on to a loser because selling would mean admitting you were wrong.
Or buying more of a losing stock because it feels smart to lower your average cost.
All of those comfortable, easy actions are almost always the ones that lose you money in the long run.
And conversely, all the things that feel psychologically difficult or even painful.
Like cutting a loss the second it hits your stop. Admitting failure instantly.
Or buying a stock that's making new highs, which feels terrifyingly risky.
Or the hardest one of all, sitting on your hands and doing nothing for days on end, fighting off the boredom.
Those uncomfortable, difficult actions are where the profits are.
So I think the question that this book leaves you with is a very personal one. Are you willing to be uncomfortable to be successful? Because if you prioritize emotional comfort in the market, you will almost certainly end up with financial discomfort. The edge lies in embracing the discipline that feels hard.
Transforming rules into reflexes. It's about doing the hard, profitable things so many times that it finally becomes easy.
And it's a journey. For anyone who wants to continue on it, Burns has more material out there, like his new Trader 101 e-course. This isn't something you master overnight. It's a craft you hone for a lifetime.
But hopefully, this deep dive has given you a solid map and a compass to start that journey on the right foot.
Thank you for watching, Lou. Please like, share, subscribe, follow up in next topic.